This week on the Art of SBA Lending.
A lot of these banks don't understand that, like I'm an LSP, I'm here to help you, but you still need to hire some internal support to start to learn this process and get educated and get compliant.
People say, oh, I've got that person sitting over there and we're paying them $100,000 a year. They don't necessarily equate that to how much it costs to do for that person to do 10 or 20 loans or whatever they did that year.
It's an agreement. They ask me, how much volume can you do? And I turn it right around and I said, well, what are you willing to give me to achieve that?
I do want to issue a correction. I was actually in college during the Great Recession, so I want to get that out there.
Wow, I feel a lot better now.
Freshman year or...
Lumos gets brought up on just about every episode these days because they are changing the way SBA loans are underwritten, especially small loans. So I wanted to take a second to explain the power of Lumos. So here's how it works. Lumos' scoring model, Prime Plus, leverages over 1 billion data points to come up with a predicted expected loss. So now you can quickly and efficiently decision each new loan request. Guys, we're talking about auto decisioning on small loans up to $500,000. They'll even sit down with you to build out a customized credit profile that matches the risk tolerance of your specific institution. Lumos is defining the next chapter of SBA lending, and it couldn't be coming at a better time with the rise of the small loan program. By the way, you can use Lumos to score your existing portfolio too, so that you can see where the weak spots are before there's a problem, and that way you know where to focus your resources. Let Lumos take your small business lending to the next level with cutting-edge analytics by going to lumosdata.com and scheduling your demo today. Well, guys, it's finally happened. The model that we all grew up with, the model that this industry was built on, no longer works. It's dead. The tide went out, and now all the bank presidents can see we've all been swimming naked. Shop after shop after shop closing. We haven't seen unemployment like this in the SBA space since the Great Recession when I was in high school. And it's only going to get worse with AI. What's causing this? How can lending institutions adapt? Stick around and I'll tell you. All right, let's start with the old model. You start with someone to run the SBA program. They hire a sales manager. Sales manager hires all of his buddies that he came up with in the 90s and early 2000s. They bring on a dedicated SBA credit manager, a dedicated SBA closing manager, maybe a quality control specialist, a construction coordinator, and maybe even an ops manager. And they do about $60 million in annual production. Today, that shop makes no money. Premiums are okay. Before COVID, I was getting 12% on a P275. Now I'm getting 10 on a Prime Plus 3, closer to 8 on a large loan. So some compression there, and no longer can you price every deal at Prime Plus 275 either. So, there's just too much competition. So you're getting squeezed there as well. And then in 2020, we all had to buy LOSs that didn't work, and we saw no ROI for several years. And then wages went up 20, 30% overnight. And then we saw defaults go up, and that was the final nail in the coffin. Over the last year or two, you saw shops closing and restructuring as a result of all of this. And so the question is, how do you adapt? Now, you could get a high-producing BDO to run a program, bring on a closer, an underwriter, maybe a second BDO, stay real lean, maybe bang out $60 million that way. But good luck when audit time rolls around. That's not a sustainable model either, in my opinion. Now, managing an SBA program, it takes skill, it takes expertise. You need process and procedure people to clear the path for the production people and just to keep everything in compliance. This stuff is no joke. When you look at the SBA landscape, there's about 70 lenders that do 100 million or more per year in 7A production. There's another, let's just call it 300 lenders that do 10 to 100 million. And that's the group that's really getting squeezed here. The big are getting bigger. And this, what essentially amounts to a math problem, is leveling these small to mid-sized departments. And I'm sure it's also not helping to get the other 3,000, banks into the program that are sitting on the sidelines. Now, What about loan service providers or LSPs, aka outsourced SBA back office? Isn't the LSP model perfect for these shops? If you talk to a bank CEO, the decision's easy. Use an LSP to launch your program. No need for fixed, expensive overhead. You get to leverage their vast amount of SBA experience, and now all you have to do is find loans, right? Well, not exactly. I'm going to lay out a few challenges with this model. Now, first, if you're trying to hire an SBA director to run the program, which I think is wise, even if you are, using an LSP, the good ones want to build it in-house. They enjoy the build. The LSP is viewed as a temporary solution until they get to a place where they can do that. When I'm saying that's 100 million, and it's hard to do that. So that's what's kind of shaking us all up here. Because if you do under 100 million, I just don't think bringing it in-house is going to make a whole lot of sense anymore. But an SBA director is going to try to convince the bank otherwise because they want to build it. They want to bring in their people. And, the second issue is the production side of things. Now, ideally, the bank has their own internal customers, but if you want to go out into the market and compete with the big boys, you're going to need to give the market a reason to do business with you. And it's going to be harder to sell on service if you're relying on a third party. The LSP model is also going to limit your ability to hire some BDOs, just the ones that prefer the internal back office, right? Because they want more control over the process. And it's for that reason that the internal model has been the winner for the last 20 years. But now that's changed. All of these bank CEOs are starting to wake up and smell the coffee. How many times have you seen an SBA director and a bank, president get into a disagreement, or, they try to change something and the SBA director quits and brings everyone over to a different bank? Happens all the time. The loyalty is amongst ourselves. SBA lenders are a unique breed, and there's always some level of tension or friction between the SBA people and the bank leadership, especially when the money starts rolling in. Sure, the first couple of years are fun. Then they notice the money that certain individuals are making. Then a couple loans go bad. The bank president decides to get a little bit more involved, and the SBA director picks up their toys and leaves to the next bank. Does that sound familiar to anyone? Banks have no idea what they're getting into when they commit to building an in-house SBA program. Just because you hire an LSP doesn't mean all of our problems just magically go away. The LSP now has the problems. The LSP has to deal with the fixed overhead. The LSP now has to deal with managing people, which we all say is one of the most challenging parts of scaling a shop. And the LSP isn't going to be perfect. They just took all of your challenges as well as 9 other banks' challenges. They have to find the more economical hiring and training practices. They have to spend all that money on technology. And I'm pretty sure that they only make money if the bank actually manages to close some deals. So now what? Well, if I owned a bank, I'm going to go with the LSP model, and I'm either going to stay there or I'm scaling to 200 million as fast as I can and transitioning in-house. And going forward, I don't think you're going to find a lot of lenders in that middle ground. So that's the new model. I'd be happy to answer any questions. Just drop them in the comments below. And without further ado, let's bring in our panel of Art of SBA contributors. With us today, we have, oh boy, this is going to be good, Mike Breckheimer, President and CEO of Windsor Advantage, an LSP, a big LSP. We have Brian Carlson, possibly the most experienced operator in the game, heading up an SBA department and an LSP right now, Mission Valley Bank and Total SBA. And we have Chris Kwiatkowski, President of SBA Lending at Dogwood State Bank, a shop that has successfully scaled, finishing out the most recent fiscal year as the number 29 most active 7A lender in the entire planet. Well, panel, welcome to the show. Let's start with just some initial thoughts from each of you. Brian, I'm going to go to you first since it's been a while. What did I get right? What did I get wrong?
Well, I think you got most of it right, Ray. I see a lot of lenders out there that think they can just do this in-house. And it's very difficult to find the expertise. And you're also right. You find people that are experts at finding deals, but they're not necessarily the best underwriter, processor, or servicing person. So you kind of need specialists in each area. And as we all know, the rules that exist are fairly complex, and it takes some time to really learn those and know how to kind of play within that framework. And so I would say that to get to where you're starting to be able to get a cost that is well, at least on par with an LSP, I would say you're probably closer to 40 million. I don't know, Mike, what do
Okay.
you think?
So I got the number wrong, maybe.
Yeah, I think it's going to depend on your market. It's going to depend on your sell versus hold strategy, and it's going to depend on how much expense you're actually taking into account with kind of your long-term business model. I think a year over year, if you're just talking about your front end, that might be the case. But I think you're probably in between 40 to 100. It's a big range. I've got a lot of case studies where clients have gone well beyond 40, 50, 60 and still not been able to truly find the talent in-house. There's a lot more factors than just volume, though, and I'm sure Brian, you would agree, or Chris, you would agree. It comes to the type of talent and the culture that you can have in-house as well, and so we can expand more on that. I don't want to dominate it, but it's more than just a direct cost to dollar amount volume, in my opinion.
I agree. I agree with you, Mike. I mean, just to jump in here, everybody has said a lot of good things already. I'm still reeling a bit from the fact that Ray was in high school during the Great Recession, so I'm getting my faculties together here. But it is a lot of different factors that go into it. It is culture. It takes two to tango. It's the SBA group or the SBA leader. It is the bank itself. What are they willing to give the SBA team? What's the time frame? I've talked about this before. You can never have too much expense in front of revenue. So it can be done. I think, Brian's more in line with the $40 million number. You get past that, you're doing okay, because you can't forget, once you build that portfolio and you've got servicing fee income, you've got interest income coming in, it's a machine that generates. So it's just a matter of getting past those hurdles. And we've all mentioned throughout your probably your podcasts, Ray, the talent. There's lack of talent out there, and having gray hair does help with the relationships. Having those people that out there that you worked with before, that will come and work with you again and build it again. Because when you do build it at the beginning, you're really skinny. I mean, it can be done, but you're really skinny. You mentioned, you could have an ops manager and a sales manager, and no, you don't. At the beginning, you have a few people, and we're all wearing a lot of hats. And we bear down, we get it done together. And you're right, I do like building a team. It's not easy. It's kind of crazy at times, but that's what you look back on as the times. Hey, we did it, and now look where we are. So a lot of different things. But going to the heart of your episode here is, I do believe there is a place for an LSP, and it just depends on the environment and how you want to run your shop.
Yeah, no, those are great points, because you're right. I mean, if you are going to try to build it internally, you can't have all those people. You've got a closer, player coach, closer, lead. You've got a player coach, credit manager, underwriter. And you've
construction is also in there with the underwriting. You can't afford to have a separate division for that right off the bat. Those take time to matriculate through.
Well, Ray, I don't want to, and we could, table this. You can moderate it for another area, but within your speech, you brought up a scenario that everybody's heard of before, right? Where an executive management team sees the profitability of a SBA division at another competitor, or they've heard the case study before, and they go all in, and then they roll in, maybe an SBA president or an EVP of SBA or GGL, and they act like they want to do it, but maybe they haven't done it before. And they like the numbers, but then maybe it doesn't mesh with their current credit culture, their lending strategy, or their operations team, et cetera. I would argue that I bet you Chris maybe has had those experiences at times, but to be as successful as he has in his past couple institutions, probably has really good communication with executive management, board level management, and his team members to ensure that everyone's rowing in the same direction. And I think you've got to have someone like Chris, seasoned at the helm, that, to your point, can curate that team that's all in it together to be able to scale it as quickly and successful as he has. I think a lot of times when you start to pluck people from a bunch of different prior shops to try to create your dream team. I actually have seen that at times not work as well. So, I know it's not all about culture, but I think culture plays a major factor and can end up making you a lot of money or costing you a lot of money.
Agreed. I mean, I what you said there was correct, Mike. When I am starting out with a new institution.
Before we get into the episode, I want to tell you a quick story. I was at the BDO retreat earlier this year, sitting next to Dustin Baker and one of the Shatterbox learners that he had recruited into the SBA industry. Her name is Sarah. And Sarah told me that she closed $10 million in her first 6 months as a BDO. I look over at Dustin and I asked him, why would anyone hire an $8 to $12 million producer anymore? Sarah is one of many Shatterbox learners who has proven that you can take a smart young person with no SBA experience, teach them SBA, and in many cases, they will outproduce seasoned BDOs right out of the gate. Why are we so willing to hire a mediocre BDO with a 6-figure salary when you can hire your next rock star, someone with unlimited potential, for half the price? You have no more excuse. Shatterbox has created the best learning platform ever created for the SBA lending industry. Join the 20 plus Shatterbox clients who have already taken the plunge on building talent from the ground up. I'm going to leave a link down below just for Art of SBA listeners. So if you want to learn how Shatterbox can help you hire and invest in bright young talent without breaking the bank, reach out and set up a discovery call today.
It's an agreement. They ask me, how much volume can you do? And I turn it right around and I said, well, what are you willing to give me to achieve that? Because if you think you're just going to hire me and that's it, that's not the case, because you want $50 million. Okay, what are you going to give me to get there? And it's a handshake, and it is a little bit of trust and faith on both sides that'll get the job done. So you're correct on that one, Mike.
I do want to issue a correction. I was actually in college during the Great Recession, so I want to get that out there.
Wow, I feel a lot better now.
Freshman year, or
yeah, I think it was freshman going to sophomore. So Brian, you've done it. You kind of see inside the internal SBA department. You see it, the LSP. I'm just curious, like, what's the biggest misconceptions out there about working with an LSP?
Actually, a good question, because I think it's a great model for the user. I ran a bank years ago, and if someone had come to me saying, hey, Brian, I'll give you a mortgage department here, and you just pay us a part of the profit that you make on every deal, or a leasing department, and you have no overhead, and it's just variable cost, I would have said, great, let's sign up. And, that's really the reason I got into this business. And yet, I don't, as Mike might concur, people don't necessarily see that. They tend to focus on the cost. And one of the things that I've come to realize is that generally it's just the CEO and CFO of the bank that understand the real cost of making a loan. People say, oh, I've got that person sitting over there and we're paying them $100,000 a year. They don't necessarily equate that to how much it costs for that person to do 10 or 20 loans or whatever they did that year. And so, not to dominate this conversation, but I taught SBA lending at the graduate banking school for 7 years at University of Colorado. And, obviously I taught SBA guidelines, whatever, but it was really more about starting a department and what does it cost? What's a logical cost for acquiring loans, underwriting loans, processing, closing, servicing loans? Obviously I had to know that to run an LSP because, as Mike knows, it's like those people sitting there are costing you every minute they're there. And so you have to have the income spinning up, at a greater rate. Kind of to wrap this up, I think a lot of people don't realize that, say if you make a loan, you hold it and you're like, oh, I'm paying an LSP, $10,000 to do that loan. That cost gets amortized over the life of the loan because the direct cost of the loan under FASB 91. And so, if a lender wants to make, have no cost, they just say, okay, I'm going to charge 0.25% more on that SBA loan. And they've essentially covered their costs and hit their target rate. To me, a lot of it is just really not understanding the cost structure of these.
I feel like the biggest, I would say, advantage for the bank, disadvantage for the LSP is taking on that operational challenge. I mean, that's the whole part of this. It's all process, it's all people, and it's all technology. And I think I stole that from Mike, actually. He's always saying those 3 words. And so I'll go to you this, Mike, but like, what is the biggest operational headache of running an LSP?
Yeah, I think There's a couple, but I think depending on. I think in the beginning, it's ensuring that your client's expectations with respect to SBA lending, closing timelines, communication expectations are set. I think we're pretty good at doing it, but sometimes it's delivering a staunch message of we're a compliance organization that happens to do SBA. You're not hiring us to just jam out loans in 5 days. I think there's this greater misconception, especially nowadays post COVID. I'll be open and say it. I very much respect Brian's group, and I think they operate extremely similar to Windsor, where we consider ourselves turnkey SBA solutions for community banks that want to scale on a variable cost basis. But there's a lot of groups out there right now that are kind of calling themselves LSPs that operate very different business models.
What are they called?
They call themselves LSPs. One might call them, I don't know, power brokers, technology companies, and I think they've got a great space in the market. And listen, I think the volume is welcome because they're helping distribute capital to Main Street, but I wouldn't say they're based or built off a similar business model to what Brian does at Total or I do at Windsor. And so one of the challenges in the beginning is setting the expectation that you guys need to make sure that you are protecting your book and protecting your client and doing this compliantly with us. And outsourcing to us at times means that we need to double check what you're doing to make sure. And then the beauty of that is these banks learn very quickly how to do it on their own. And to Brian's point, once they scale up to a certain level, that gives them the talent and they get to copy the processes. And then if they want to invest in the technology, they can then take it in-house. And I view that as a win. So timing and expectations in the beginning, right? And then there's this perceived loss of control at times when you can't walk down the hallway to someone, or I think it's probably getting easier now with remote employees, but we always say when utilizing a good LSP that's in communication with you, you're outsourcing the admin and the work, not the control. And if you feel like you're losing control, you need to communicate as quickly as possible. But that's been a challenge, we constantly face, is someone saying, hey, listen, I'd love to use you, but I just feel like I got to keep it all in-house. And because I feel like I can be more confident with respect to how I'm touching my borrowers, how I'm understanding their current stories, and how I'm communicating to my executive team. So I hope that helps.
Let me piggyback on something you said there, Mike. That was interesting. A lot of banks feel like, I could ramp up quickly and get some volume, quickly with an LSP. And maybe I know you're not blind to the fact that the responsibility is still on the bank at the end of the day.
100%.
I mean, if the deal goes bad, the LSP the bank's the one responsible. The SBA is going after the bank. If the guarantee is going to be repaired or denied, it's the bank who suffers.
Yep.
So I understand, you and Brian understand that, but I think there are a lot of banks out there who see the LSP model and they see that shiny object, they run after it, and at the end of the day, they don't realize, and they turn to you guys, well, what happened here?
Yeah.
And you read the contract again, guys. It's still your responsibility. So that people need to be aware of that at the end of the day.
Yeah, we're there to help you scale if you want to be able to utilize this incredible product to offer money to your borrower base and help allocate capital to Main Street, but it's your credit decision. It's your balance sheet, right? We have hundreds of clients that all make different decisions different ways. And in the end, you need to take your 7A opportunities to your credit department and have a very active conversation about whether or not this fits your culture internally. We'll do the work, but you've got to be able to understand how to make that decision.
And if you don't have a bank that understands SBA and they just think it's an automatic insurance policy, it's an automatic guarantee, they'll be elbow deep into it before a few go bad. And, and then they're all of a sudden, I wasn't aware of this, and it leaves a very bad taste in their mouth. And everybody in the SBA reputation suffers because of that, because the bank gets out, we don't like this, SBA is a bum deal, et cetera, et cetera.
Yeah, I don't disagree with Chris. We see, and I'm sure Brian does too, opportunities quite a lot where there's a slightly seasoned portfolio where a group went in there, originated quickly, either with an LSP or a broker relationship or internally. They didn't understand totally what they were getting into. 24 months later, that default rate's higher than anybody ever projected. And to your point, Ray, like some of the talent left because, this is a concentrated market at the moment. And these banks are kind of left hanging with what do we do next? And so we've helped clean up, a many portfolio as well. And so I guess for a disclaimer, like if you don't have a Chris, make sure you're choosing the right LSP and you're really thinking about the strategy and you have some people in-house that understand the product and want to work with either us or invest in the fixed expense to be able to do it the right way. Or you're going to get burned and it's not going to be a long-term strategy. I fully believe that.
Brian, you have built, internal, at Mission Valley Bank, and you've also ran multiple LSPs, built multiple LSPs. I'm curious on the client relationship side, like what is the secret to a successful long-term relationship between the LSP and the bank, and where do things start to fall apart?
I guess that there's a lot of answers to that question, Ray. The one thing is very similar to actually running an SBA department. Every SBA department I've ran, I've made sure that the management of the bank had a burning desire to do SBA, and to everybody's point, understood it. Because I said this before, it's like playing poker. Now you said twos are wild, it's like, it's just a different dynamic of looking at what that guarantee brings to you. And it takes a while to understand, well, I'm not going to make loans based on the guarantee, but I shouldn't ignore it either. The key thing I see is that insurance policy you get from the SBA is only good if you have good people behind you to make sure it gets done right. And, we've had essentially a perfect results on getting guarantees perfected for our clients. I mean, loans go bad, but at the end of the day, you want to be in this business because there's nice margins, but you have to make sure that guarantee is rock solid. And ultimately, that's the key to the business.
Yeah, and there's several different models that people do. I mean, these are all the foundational components that you need, and I've kind of laid out a few different models because I have seen some high producing BDOs step into a player coach director role, and I do have some concerns with that. It depends on who the BDO is, right? I've seen it done the way Chris is doing it. I think Chris does it as well as anyone. Some
Agreed.
people try to do it like Chris is doing it, but I see a lot of people doing it that way, essentially. And then I see people using LSPs. Are there any other models that I haven't considered? I mean, there's the internal bank sort of model we don't really talk about too much, like a bank that just wants to service their customers. But
Yeah.
is anyone else doing it any different ways that you've seen?
You kind of see some banks that think, well, we can do this. And, it's bad for a number of reasons. One, they don't know what they're doing. But then secondly, it's a terrible experience for the borrower because, as Mike knows and as Chris knows, it's like you have to do everything sequentially. And you can't be like, okay, what's next? What's next? What's next? It's like you have to have a lot of things moving forward at the same time and be hitting kind of critical paths to make sure you've got, appraisals order, whatever it is, done in time so that you can meet a reasonable closing date. I pity the poor person that gets an SBA loan from, a small bank that hasn't done any or has done, 2 a year, because it's just going to be a protracted, unpleasant experience.
That hurts everyone. That hurts the customer, it hurts
Yep.
the bank, and it hurts the program.
And I think the larger banks, there are larger banks out there that obviously will utilize the Express program. I don't want to deal with the full-blown 7A. I'm going to use my own documentation. I'm going to do the Express program. And they do a lot of volume that way just because they have so many customers and so many opportunities.
Yeah, that's true. None of us like out here in the world of SBA production shops really do that Express loan program. Except Live Oak just launched it, I think. What else on the models?
I mean, you ask about models, right? So when utilizing an LSP, there's turnkey, right? There's a la carte. There's other groups out there that specialize in maybe like just underwriting or, just packaging or just closing, maybe just servicing. So I know, we typically are a turnkey solution. I believe Brian is typically a turnkey solution as well. We tend to believe that helps us integrate with the culture of each one of our clients. But, for your listeners out there, there are quality shops that offer the onesie twosie services off the menu. It's not my business model. I frankly don't enjoy the client experience at times, but there are shops that I know do it well. So I think when working with an LSP, Ray, you asked about the models. I think you've got some that can give you the a la carte and some that typically try to work on a consultative strategic basis to be with you, at least I call long haul, your scale up period.
I gotcha.
Those are kind of the two major ones I typically see outside of like the straight outsourced BDO shops that maybe quasi get looped into that agent LSP relationship, but I would argue are a different sect of a business model than what I or Brian do.
Well, I want to shift off the LSP. Oh, I'm sorry. Go ahead, Brian.
I was just going to say, kind of getting back to understanding costs, we will do kind of one-off. So if someone just wants us to underwrite, we'll do underwriting. And I was talking to a banker, they'd called me and kind of in a panic. They had an SBA underwriter who left. They only had one. And they said, hey, can you kind of fill in for us? And I said, yeah, probably typical underwrites, maybe 3,500, $4,000. And he was like, oh, wow, that seems like a lot of money. And so I said, well,
I think that's cheap.
Well,
do the math. Do the math.
But I asked him, I said, well, how many loans did your underwriter do last year? He did 15. And I said, how much were you paying him? $100,000.
Yeah.
So, that's not hard math. So, then he kind of came around, okay. But it is funny how, people look at costs and they don't necessarily understand, the whole picture of those costs.
Yeah. So it is incredible. I mean, it's all a math problem really, but you need people that actually know what they're doing to lay it all out, that know how many deals a month an underwriter should be underwriting and closer should be closing and things like that. Now, if you build it in-house though, Chris, I want to go to you with this because I want to try to understand a little bit more of the distinctions or really the advantages of doing it in-house. I mean, it's from a competition standpoint, from a recruiting standpoint. I mean, why do you feel like that was the better model for you?
Well, you just mentioned some of them, Ray. So, I mean, you mentioned before, if you want experienced, serious SBA salespeople, they're going to want to work with a PLP lender. They're going to want somebody who can turn the deals quickly and has the resources. The control. Yes, I mean, we like to see where everything stands and with the control, et cetera. It's just what I've done, and the scaling of it you mentioned as well is very important. I think people are disillusioned with what they think an SBA underwriter should do. Brian mentioned, hey, that underwriter did 15 deals last year. Good Lord, man, if you're only doing 15 deals a year, you should not be in the business. I mean, if you're not doing 15 deals in 3 months, that's a quarter, so it's all about the expectations and the scalability. I have a model. I know a BDO, if I expect my BDO to do X, that means X amount of applications coming in. That means I need X amount of underwriters handling so many deals, and then X amount of closers handling those. And realize the funnel, when sales brings it in, is up here. It gets through credit, it's down here, gets to closing, it's down here, and you still have fallout in closing. So you have to back into your numbers with that model, and that's the way you scale. So you can't get too much expense in front of revenue, and that's the important part when you're starting up, is to recognize, guys, it's going to be tight up front. We're all going to be doing a lot of things up front, but once we get over the hump here, we can start to bring on more resources, and start to expand our offering. But it's a different animal at the beginning, and you do need trust and you do need faith doing that.
Mike, you talk to a lot of bank presidents, and I'm just wondering, what are some of the red flags you see in those early conversations? And we talk a lot about it on the side where they're not serious, but what if they're really serious? What if they tell you hey, I want to scale to 200 million, within the next year?
So those conversations happen a lot because a lot of what we like to do is actually sit down, understand strategy, understand desires, and figure out okay, what do we need as a partner to dedicate in terms of resources to help them be successful. And we have, no minimums, no, it's completely variable, but we know what we have to commit to help someone who is serious about hey, I want to scale to 200. And, first of all, they'll say, I want to scale to 212 months. I'll say okay, so it's going to be 36 months, just immediately off the bat. So are you okay with that? And then, right, things like that. And then a lot of what I see as a red flag, Ray, is not understanding the amount of commitment that has to come from the board and the executive team about these types of loans. If a lot of these banks love the idea of the fee income, but haven't really lent to kind of a cash flow based product before. A lot of these banks don't understand that, like I'm an LSP, I'm here to help you, but you still need to hire some internal support to start to learn this process and get educated and get compliant and understand this model internally. So usually I immediately tell them they probably have to hire a couple more people than they initially thought. And then, the last part is, by the way, I've spoken to some that are incredible, but I felt a lot of presidents have heard about this from competitors or other areas, and they don't understand how hard it is to do what Chris and Chris's front end team does with originating quality deals and pricing them at prime plus 275 and getting them into the box that fits your credit culture. Like that is what you and Chris do is not easy.
Well, Mike, and you mentioned, when we want to scale up to 200 million, my first question is, can I talk to your chief credit officer?
Yes, exactly.
Are they on board with this? Do they understand what SBA lending is? Because that doesn't, if you have a chief credit officer that loves SBA, okay, why aren't you doing it internally at that point?
Right.
That's part of the thing. So if you don't have a chief credit officer that knows SBA a lot, you're going to an LSP, and you really need to talk to that chief credit officer and understand these are cash flow deals. You're not going to have collateral. You're protecting the guarantee is what you're doing here. That's your collateral. I'm not saying run out and do $5 million air balls, but you are doing under collateralized loans here, and your guarantee is your collateral. Do you understand how to protect that? Are you okay with that? And that's a conversation that needs to happen.
Yeah.
Yeah. The overall climate today, the environment, compared to, let's just say 10 years ago, when you're building out a shop with those factors I mentioned at the top, what do division leaders need to be thinking about if they're setting up a new shop today? What do they need to be doing different now in this type of environment?
I think, I run my shop. We only have 40 people in our shop. That's the largest we've been. I don't want to say we do it on the cheap, but we run lean. We do expect a lot out of our salespeople. I think the model of just throwing bodies at it, hey, I've got 300 people out here. We did 300 million last year with 300 people. And I'm going, okay, great. Well, what does that average out to per FTE? That's $1 million. I'm averaging 4.5 million per FTE. Sure, you're doing more volume than I am, but who's more profitable? So I think it's that understanding of you can't have too much expense in front of revenue. You do need to do it very diligently and keep an eye to expense, not to cut off your nose to spite your face, because you do need to invest in the right people. I will say that. Don't get, hey, I need a construction person, but SBA construction people, they're more expensive than conventional construction person. We're just going to hire this conventional person. Man, that's just a nightmare. It ends up costing you more money at the end of the day. Same thing with special assets people. Get a special asset person that knows SBA. Yes, they cost a little bit more, but you're going to save money on your guarantee at the end of the day. So it is a fine line between knowing where to spend your money and knowing where to keep a tight handle on the purse strings.
Chris's comments are completely aligned with how to run a successful operation, right? And so, Chris has been able to do it in-house with teams that he understands and people he's been able to recruit and has done a great job. It's just a matter of, rarely do you hear, and it's not you two gentlemen, but in the general world of sales, whether it's SBA or elsewhere, do you hear the business development, Chris runs a little department, group say, hey, we really need to mind expenses in the beginning to understand that we've got to keep that break even as low as possible so that we can hockey stick.
Mm-hmm.
I tend to not see that a lot. So when I'm speaking to bank presidents, I see some people that got invested in sales, invested in 10 people immediately or a bunch of people immediately, went upside down because the volume didn't come in quick enough, which is why I'm always saying, do you understand how hard it is to originate these loans? That's why at times, it is a pitch for LSPs. If you don't have that set business model, that a guy like Chris has established and already been successful with, utilizing an LSP to variably scale with you in the beginning is the right way to go, because sometimes it takes longer or markets change, and we help you obviously understand the trade so that you can protect your own guarantees and keep your portfolio compliant. It sounded like a pitch, but it's like, we say, like, it's funny because what Chris, like, I have these exact same conversations, and I'm not a business development guy. We don't originate any loans. We are there for compliance, but it's the exact same conversation with credit.
Well, let's talk. Oh, go ahead. I'm sorry,
No,
Mike.
go ahead.
You talk about the backside of this too. Now, we have been on a good growth trajectory here. What does that mean? That means we're getting Okram audits every 3 months. You know, hey, can we review this? Can we review that? I mean, it's happening. So you have to be ready for that as well. And if your management team isn't ready for, oh, by the way, who pays for those reviews? We do. You know, so that happens when you're growing fast. You can be doing everything right, but you're growing fast. You're still going to get those reviews all the time. You need to be ready for them. You need to understand what it takes to, okay, I got these 5 files now. We got to scrub them. We got to go back and forth with the SBA. They're going to send us a bill at the end of the day. It's okay. Don't panic. But you have to understand that's part of the game as well. And we haven't talked about that.
Yep.
So one of the best parts about starting with the LSP that I've learned, and I'm kind of new to this, and we use Windsor. Windsor, works with Truliant, and they've done a great job, and we've been transitioning in-house. But as we're transitioning in-house, all of a sudden we get really busy, and we still have Windsor to fall back on, which is nice. Whereas historically, when I've been at a shop that just fully cut ties with an LSP and we get really busy, well, the turn times are going to have to slow down right now. You have no other option. You can't hire fast enough. And do you even want to add headcount? Because is this just like a wave of new deals, or, is this going to continue? And you don't really have to make that decision if you have sort of an LSP kind of waiting in the wings that are still getting, because, if you're getting 20% of 200 million, it's still a lot of business for a lot of LSPs. Brian, do you think this is a good time to pick up talent right now? Because I'm seeing a lot of open to work signs on LinkedIn.
I'm sure we're all looking for talent all the time, but I haven't necessarily seen that there's that many people out there in the marketplace. Usually I get recruiters, presenting people when there's a flood of people, and I haven't gotten a bunch of calls lately, but maybe you're seeing things sooner than the rest of us. To get back to your prior question, though, about the current times, one of the things that we are incorporating is in our credit write-ups is an analysis of potential impacts to a borrower based on tariffs. If they import a lot of their product or they're an exporter, what are those impacts? And I think that's an important thing for the bank and the regulators to see that, you're fluctuating or you're adapting your credit analysis to the current time. Certainly we did that during the pandemic.
Huge hot topic right now. I literally just got off a call with someone who's buying a business that sells product. I'll just say it's solar. I can say that. We're seeing 30, 40, 50% tariffs on different countries in Asia. And this is a first-time buyer coming into a business. And, one of the first questions we're asking is about these tariffs. And they don't really have the answers because no one knows what's going to happen. And
that's it. I mean, do you have the answer? Nobody knows. I mean, it's a wait and see right now. And could it go away next week? We don't know. So it's very difficult. And I feel very bad for these small businesses who are trying to adjust, but they don't even know what to adjust to just yet.
A lot of short-term issues with this. And I even said, possibly might be a reason to open up idle for, if you can show your business has just been destroyed by tariffs. I mean, to me, that's like a pandemic situation where, how can you function if all of a sudden your cost of goods goes up by 25%? And can you really pass that on to a customer, like this overnight and not get impacted? So I think that kind of wraps us up. I would like to get some final thoughts, kind of thinking from a big picture, high level standpoint in the current environment and going forward with the idea of technology and AI, and we throw around these words, but I mean, we're getting close to it replacing all of us. And, it's how should we be thinking of starting an SBA division in this type of climate? what is one thing that a bank president should know before they get into it? Just give us one word of wisdom each. And Brian, I'll go with you first, if that's okay.
Well, the thing that I've always said is that all banks see SBA loans, and they get a loan in there and they look at it and say, well, this is a money good loan, but it doesn't fit our credit policy. And if you don't have a way of executing that loan, you're really doing a disservice to your customers or potential customers and growth. And so that would be my advice to, these community bank presidents, that there are good LSPs out here that, can assure you that the job gets done right and efficiently. So your client has a good experience. You should really take advantage of that. I'll also throw in that, in addition to Windsor, Total SBA is one of the leaders in the industry.
Mike?
Yeah, there is, in my opinion, no better fee income based product for a bank looking to scale or solve a problem or looking to hedge concentration. And they can have a positive impact on their community while doing it. And there isn't a lot left in this world where I think you can feel really great about what you're doing for a small business or a United States citizen, helping them fulfill their dreams while also adding a ton of value to your organization and helping boost your career. And so it's another way on kind of the top line side of echoing off what Brian said, which is if you're not utilizing this product, you really need to look into it, because I don't know a fee-based income product for a community bank that doesn't have a lot of options out there that's any better than an SBA 7A loan when done the right way.
Agreed.
We need to have you do a commercial, Mike. That's awesome for SBA. I would say for any bank president that is looking to, what do you want to achieve with SBA? Is it just to service your existing customer base, to take care of them when there's an opportunity that doesn't fit your current credit box? Is it to get CRA? Is it to have good PR because we're doing a lot of small loans out there with Express? And none of these are wrong, by the way. Or is it, do you really want to go after this? And as Mike pointed out, you're not going to find a better product for fee income. It really is fantastic. So you need to know what you are expecting from SBA. Once you know what you want to achieve, then you can talk to an LSP. Then you can talk to somebody like myself and say, here's what we really want to do. Am I the right guy for that? Or do I need to invest in a guy like you? Do I need an LSP? So really know what you want the program to achieve, because it obviously can achieve different things for different people.
Do you think the golden days of SBA for us as SBA employees are over? Like, do you think there's going to still be these opportunities for people like you? And I mean, yeah, but like, there's a lot of people that are, not as skilled as you that have had those opportunities and have, had, and it hasn't worked out for many of them. And I don't know, are you think these opportunities to do this type of thing and build these in-house departments is still going to be as big as it has been the last, decade or so? I
think they're out there. I do think they're out there. The SBA industry goes through cycles. We all know that. We've been down before. We've come back around. It's just realistic expectations. Listen, and people get selective amnesia too. Let's face it. After time, we'll go back and do something. We'll touch the hot stove again. So, I definitely think there's always going to be a place for SBA lending. It's a great public-private partnership. It's just a matter of when's the right opportunity, when's the right timing, because a lot of it does come down to timing. But absolutely, I believe there's going to be opportunities for SBA lending in the future.
I just don't want to see it get to a point where the big are getting bigger and bigger, like in residential mortgage, and the community banks can't compete.
Well, we've had bigs before. When I was coming up, it was the money store, and then I was part of AT&T Capital CIT. Where are they now?
Dude,
now it's Live Oak and Huntington. Okay, people cycle through. Wells Fargo was huge. They've cycled through. People are ready to take their place.
Have you guys looked at the numbers recently, the rankings?
No.
Newtek's number one, aren't they?
I think Live Oak might have taken it back, but they're trending. Two of these shops are trending towards. So right now, 5 months in, you've got $2 billion. You've got two people over $1 billion 5 months in.
Fantastic.
Meaning they're trending towards over 2 billion of authorizations. And that is Live Oak and New Tech. That's just crazy. The top 10, to get into the top 10 these days, you need to be doing half a billy, which is nuts. But gentlemen, thank you so much for being here. That was quite fun. Until next time, ta-ta. All right, that's it for this week's episode. If you want more SBA content, you can sign up for our monthly newsletter and check out our sister shows, SBA Today and The Video Show. We'll leave a link in the show notes. And don't forget to subscribe to this podcast so you never miss an episode of The Art of SBA Lending. Ta-ta.